Now, that homework video lecture is basically the same as the problem you're going to have on Connect, except they use a different dollar amount or two. But you have to be more disciplined in this course and always look at your modules. This course, again, is not actually connected to Canvas when you do the Connect homework. I do that for a number of reasons because they use a different point scale on exams versus what I used likewise in the homework. So that's why it's separate. And when you want to look at the due dates, you can go to your modules. That actually shows you what's due on a weekly basis. Likewise, go to your Connect site, and on that Connect site, it has all the due dates listed of your exams as well as your homework assignments. So make certain you keep up with the course. Do not get behind. Also, if you're not submitting the assignments on the due dates under Title IV, I have to remove you from the class for not participating in the first few weeks. So you want to keep up with your assignments. And if you do, it's not too difficult of a course. But everything is spelled out for you. I will not ask you anything on the exams that's not covered in the lectures, be it the chapter lectures or the homework lectures. So I spell everything out for you and what you need to know. And with that being said, we can get started with the very first introductory chapter. And by the way, the first 3 chapters covered in this course deal with financial accounting. So we do chapters 1 and 2, and then we skip all the way to chapter 18 out of your ebook, because that's looking at financial accounting. And after you have your first exam on chapters 1, 2, and 18, then we will turn our attention to managerial accounting, where you'll be an insider to the company and making decisions as you would if you were in management or marketing or an employee within the company. When we're talking about accounting, very important, and you hear this slogan a lot in accounting, that accounting is the language of business. Every decision is business is based on some kind of information. As far as they're making decisions about these companies, various individuals such as investors and creditors, whether your company's borrowing money or people are deciding to buy your stock, or a fund manager. Customers even decide to buy your purchases based on your selling price and also the history and reputation of your sales. Suppliers decide if they're actually going to actually grant credit to the company, because again, when you're buying merchandise, you're not paying for it on the spot. Managers, of course, are looking at accounting data just to see how they're doing on a daily basis with regard to production and sales, and then services if they're in the service industry. Employees, that's something you should consider whenever you're actually interviewing for a job, is how well is the company actually doing? Are they posting a profit? What's their financial situation look like? Do they have an excess of liabilities? Competitors are also grabbing your financial statements to compare your results with theirs. Regulators, of course, are looking to see that you're following the laws. Tax authorities, whether you're, of course, paying your fair share of taxes, you have to file your tax returns. Even local communities are concerned about environmental issues, and also in order to attract a business, they're looking at their financials to see if they're viable. When it comes to financial accounting, the whole idea behind it is to provide useful information to external users. So that's the key. When you're looking at an annual report, it's geared for external users. Now later, after we cover our first 3 chapters, 1, 2, and 17, we're going to turn our attention to insiders to the business. There's 2 functions of a financial accounting. One is to measure business activities of a company. So on a daily basis, companies are out there measuring their day-to-day activities. Also, they want to communicate those measurements to external parties for decision-making purposes, and they're going to do that through the financial statements. With regard to the framework of financial accounting, really it all starts with, of course, the accountants. They're going to be measuring things, communicating that information to investors, creditors, and others. Those individuals are going to make decisions, and it's not just limited to investors and creditors, as I said on one of the previous slides. They're going to be making decisions about the companies, and again, those companies are going to go through various actions and transactions. They're all going to be measured by the accountants again. So that framework just continues that cycle around and around and around.
When it comes to the types of business organizations, you have three in all. A corporation is mainly what we're going to look at in this particular course. Legally, it's separate from the owners. As far as legally binding contracts and so on, it's not between the creditors and the shareholders. It's a representative within the company, so that's what we mean by limited liability. Now, with regard to sole proprietorships, as it implies, sole being that it's owned by just one person. And of course, partnerships where you have two or more people forming a company because one person feels that they can't go it alone or they need the expertise of others. Now, if you ever see an LLP, they are set up that it's somewhat like a corporation. LLP stands for Limited Liability Partnership. And in that case, they do have what we call limited liability. Now, this statement here implies that it's not an LLP, but sole proprietorships, all of those, and most times these days you see partnerships forming as LLPs because they want the protection of limited liability. The accounting equation is the only equation you actually have in these first three chapters. It's this simple, and it was developed in the 14th century by Paciolius, mathematician, and it's still used to this day. You have your assets. Assets are basically resources. They're things that they have economic value to the company and service potential. For example, their office headquarters, all the equipment that goes in there, their warehouses, all the assets within their store locations in the store building itself. So that's what we mean by assets. Very similar to, of course, what you think of when you are an individual and you're filling out a loan application. It asks you what your assets are. Obviously, if you own a home or whatever, you'd list that, your automobile, any savings that you have. So all of those items are considered. The cash that you have, savings, CDs, accounts, those are considered assets. Liabilities, of course, is what you owe other parties, and the same applies to companies. You have your creditors. They have claim against the assets. For example, if you have a mortgage or if you have a car loan as an individual, that's considered a liability. And then your shareholders, of course, that's the owner's claim. So it's real simple. If you say that somebody owns their own business and it sounds impressive, they tell you that they have business assets of $1 million. However, if they owe their creditors $950,000, that means their equity in that company is only $50,000. Not that impressive after all. But again, the shareholders, of course, it's several individuals or thousands of individuals have an interest in those assets after the creditor. So they're a residual claim. And that's why we say those are the claims to the resources. As far as assets, again, those are total resources or items that have economic value. Liabilities, those are the amounts owed to our creditors, just reinforcing some things here. And stockholders' equity are also claims to the resources, but of course it's residual in that, like I said, if you have assets of $100,000 or $1 million, liabilities of $950,000, then your stockholders' equity would be, of course, $50,000 only. Basically, the accounting equation is your fundamental model of business valuation. In fact, there's a financial statement that we'll talk about, the balance sheet, that is based on just this one equation. Revenues, expenses, and dividends. Let's talk about those a little bit. First of all, revenues are very simple. They're recognized when a company sells a product or provides services to customers. Basically, the customers owe you money. Expenses are cost of providing those products and services. So anything that you're using up in the course of operations, that would be considered an expense. For example, the fuel that you're using in your delivery trucks, paying those drivers, your utility bills, all those things are considered to be expenses of operations. And of course, your net income. When it comes to net income, it's simply the difference between your revenues and your expenses. And some companies call it a profit. Sometimes your authors will do that. Instead of saying net income, they'll say profit. So don't be misled by that. It's synonymous out there in the business world as well. And there is something out there called dividends. Now, notice, I do not put dividends under expenses. Dividends are a cash payment or reward to your shareholders. Just as you would be paying interest on loans to your creditors, companies will declare dividends. They don't have to declare dividends, and it's optional as far as how much they want to pay out as dividends. But a lot of shareholders make investments in stock because they want dividend payments as a return on their investment. Those are the cash payments to your shareholders. So again, just keep in mind that they have nothing to do with expenses or your net income determination. This is a good summary slide as to where things are measured. First of all, when it comes to finding out about the assets of a company or the resources, you're going to see that, of course, in your equation. Assets equals liabilities plus stockholders' equity. Same thing when it comes to any amounts owed. They're under your liabilities. They're going to be, again, listed in the equation. And stockholder investment, that's going to be under there as well. Now, when it comes to distributions to shareholders, the dividends, we'll talk about where that's going to be actually showing up on one of the financial statements. And then, of course, you have your sales being your revenues, and whether it's for products or services, products that you're making, or you're buying somebody else and retailing the sale to your customers. And then, of course, all your costs of providing those sales. Those are your expenses. And that's going to be the income statement, where we actually show you our net income. And of course, if you have a net loss, that would be the opposite, where expenses exceed your revenues. And you see that quite often out there. A little question for you to think about. The total resources of a company are referred to as what? Just to see if you're keeping in mind what I said with regard to the prior slides. I hope you're thinking immediately that the answer is C, of course. Those would be your assets. So again, assets are economic resources. They have value to you. And as I said over and over again, what are some examples of assets? Well, obviously, cash is an asset. You have your supplies, your inventory for sale to customers, and you're retailing or manufacturing, you have a lot of inventory. Buildings, land, and equipment, and of course, various investments that you would have. So those are all the different categories that we'll talk about under assets. And some companies literally have thousands of different assets, believe it or not. The reason I say that is think about somebody like a Walmart. They have numerous stores, thousands of stores out there. And when you count up all the assets in those stores, all the registers, the supplies, the buildings, and everything else that goes in it, and the equipment, the shelving, they of course have, their accounting records are just unbelievable as far as the number of assets that they actually own. When it comes to communicating through the financial statements, we actually have 5 financial statements in all that are published for users out there. The income statement is the easiest, and it's the ones that we'll look about preparing for preparing first, I should say, as well as then we need that number, the income statement, to get a statement of stockholders' equity. You'll see why shortly. Then, of course, your balance sheet. And the way to remember always what goes on a balance sheet is your equation must balance. Assets must equal liabilities plus stockholders' equity. And then my favorite statement, of course, is the statement of cash flows. There is a 5th financial statement out there, but it's way too advanced. Your authors talk about it. I leave it out, totally out of these PowerPoint lecture notes. Was the statement of comprehensive income. You really look into that more when you probably get into not even your 201 course, but probably if you're going on as a finance or accounting major in intermediate accounting. The income statement, like I said, is probably the easiest statement of all, and notice it's for an interval of time, whether that's for the month. A lot of companies will look at monthly financial statements, even though they don't release them to the public. A quarter, yes, companies do release quarterly earnings. And then, of course, everybody issues financial statements for the year, even fairly small companies. And like I said on a previous slide, if your revenues are less than expenses, then you have a net loss instead of a net income. Keep this point in mind. Your revenues and expenses on your income statement actually give you or show you the company's ability to earn a profit from running its operations. That's why that's one of the most important numbers on all of your financial statements. Unfortunately, it's probably an overused number because it's not as exact as you might think. And when you study further in the ACC 201, you'll see why I say that. But I'll just briefly mention some things as we progress through the first 3 chapters here as to why that net income number is not really that precise. It's not going to be as precise as cash flows from operations. So making this up, of course, your authors show you a simple income statement, coincides with the textbook, where you have your revenues less your cost of goods sold. And notice it doesn't use the word expense, but that is an expense of doing business. That's how much you paid for those goods. And the difference between that is called your gross profit. Now, notice they say net income down here, but some companies will just say profit. Gross profit is different than just profit. Gross profit, as it implies, doesn't take into account all your other expenses. This just takes into account how much it cost you to buy those items that you're actually selling, or how much it cost you to make those if you're a manufacturer. Then you have all your operating expenses out there, the depreciation that we'll talk about, the payment of wages, utility bills, warranty expense, all kinds of various expenses that you're going to incur. That gives you your operating income of $65,000 here. You have various other revenues and expenses. They give you one here being interest expense. Interest expense is shown separately to get your pre-tax income, and yes, you got to pay taxes to the federal and state governments, and that's out of your control, and that's why we don't call that an operating expense. You really can't cut that. The only way you can cut it is have less income, and that's not always a good thing. But you then have your income tax expense to give you your bottom line number, net income. So in simple form, that's a basic income statement. We'll make it a little bit more complicated and realistic as we progress through the next chapter. That would be chapter 2. With regard to the statement of stockholders' equity, as stated here, it's just a summary of changes in your stockholders' equity over an interval of time, just like the income statement is over several months if you're talking about a quarter, or the entire year if it's your annual income statement. Your stockholders' equity, very important that you understand this, is comprised of 2 components, your common stock and your retained earnings. Now, what do we mean by common stock? Whenever investors buy your shares from you initially, notice I say initially, that you're issuing stock, they're giving you that money. It's not when you hear about stock trading in the market. That's investor A selling to B to C and so on. These would be your initial shareholders. They invest that money into the company, and in reward, they get to own shares of common stock. Retained earnings is an internal source of company value, or a component of stockholders' equity. As it says, retained, being kept, earnings. So think about it. If you have net income, what net income increase retained earnings? Net loss would decrease your retained earnings. But then, let's say you have net income of $100,000, but you paid out dividends of $80,000. Do you see that you only retained $20,000 of that? And as companies grow, and over the years and decades and so on, companies have much more in retained earnings versus the original investments by shareholders. Sometimes it's 10, 20 times fold the amount of shareholder investment when a company has been around and very profitable for a number of years. But those are the 2 components to stockholders' equity. Very important that you understand that. The original investments by shareholders, that would be the common stock. Then the retained earnings, which is the income kept after dividends over the years. And notice that's a cumulative number. When it comes to looking at a statement of stockholders' equity, just making this up again, following through with your author's example, we assume this company was non-existent on December 1st. So they had zeros across the board. Then during December, they issued common stock for $1 million. So if they had investments by shareholders, the common stock would go up by $1 million. And if they generated net income, remember this was the net income number on the income statement? So that would be added to the retained earnings. And that's why we say here you need an income statement first, because you use that net income number on your statement of stockholders' equity. So those are your two components to give you your total stockholders' equity. Now they're assuming here that, if you're saying where did they get that, they made it up. If you paid out dividends of $14,000, then you only retained or kept $31,000 of your retained earnings. So in all, at the end of the year, you have $1,031,000. So really your beginning retained earnings, you take that, add your net income, and then you deduct your dividends. Now if I was looking at the next month, being January, I would start out January with $31,000 instead of zero, as we did on December 1st. Then I would add that month's net income less the dividends. Okay, some two common mistakes that students make with regard to dividends. First of all, they are a payment of cash, but they're not an expense of doing business. So many students think that dividends are shown on the income statement. Instead of showing them up on the income statement, you're going to see those on a statement of stockholders' equity. They have nothing to do with daily operations. They're not an expense incurred to operate to generate your sales. It's just a reward to your shareholders. So that's very common for students first being introduced to accounting, thinking that dividends go on an income statement. No, they go on a statement of stockholders' equity to get your retained earnings or your earnings kept in the business. With regard to the balance sheet, this is the only statement that's for a particular date. So far, we covered the income statement and statement of stockholders' equity. Notice we were saying they were for a period of time. Now, the balance sheet is actually a snapshot of the company's financial position as of one date. So your resources less all the claims to those resources, which of course, is your assets and, of course, your liabilities plus your stockholders' equity. So those would be your two components on the right-hand side. So again, when you're looking at a balance sheet, think about your assets and just cash, how that's going to change on a daily basis. The balance sheet cannot be for the period ended as far as a period of time. It has to be as of one date compared to an income statement or a statement of stockholders' equity, because those numbers for assets especially change on a daily basis. Likewise, your liabilities change with you making payments to creditors and writing out checks for supplies and inventory that you receive. Now, notice the balance sheet's dated as of one day, December 31st. So with our Eagle Robotics, and again, we're just making up these amounts, notice the listing of assets that you have here. Cash being the most liquid one, and that's the order of assets typically. How fast they're going to be converted into cash or used up. Then we become accounts receivable. Now, what are accounts receivable? That's when a customer sells merchandise to a customer, and the customer did not pay them right away. In other words, that customer owes them money. That's an asset from the company's perspective. For example, if, let's say you had a Macy's credit card. You walked in, bought some merchandise, use your Macy's credit card. Notice I say Macy's credit card because if it's Discover or Visa or MasterCard, that's as good as cash at the end of the day to Macy's, less a fee that's taken out. But accounts receivable would be listed as an asset in this case for Macy's because they sold that merchandise, but the customer has yet to pay them. Supplies, if you haven't used them up yet, that's an asset. Same with all the inventory. Other assets being things like land and investments that they might have, and then the equipment. They say net because there's something called depreciation out there, and we'll eventually get to that in Chapter 2. But your total assets are $1,650,000. Now, that's just after the first month of operation, so they acquired a lot of assets in that time period. And of course, in that first month, they had net income of $45,000, which wasn't bad. Most companies starting out lose money. They have a number of liabilities. Accounts payable is just the opposite of an account receivable. Basically, we bought merchandise, and we have yet to pay our supplier. Typically, they give us 30 days to pay. So we owe some $14,000 to our suppliers. We have some unpaid wages. Notice it says payable. We got some taxes that we owe, some interest that we owe, and we got some other liabilities. And also, we took out a loan for $500,000, so that's a note payable. So in all, out of the assets of $1,650,000, we have liabilities of $619,000. As far as the stockholders' equity, we had these numbers, remember, from the stockholders' equity statement, the statement of changes, I should say, in stockholders' equity. We had $1 million invested by our common shareholders, and we retained them $31,000. And notice that amount, as we note here, is coming from your statement of stockholders' equity. So pretty good. The shareholders still have a significant interest, or at least over 2/3 interest in the assets of this company. So they're not all that heavily indebted at this point in time. Sometimes you'll see companies where their liabilities are 80% of their assets, if not more. But notice your equation balances, of course. Assets must equals liabilities plus stockholders' equity. So that's what a balance sheet actually looks like. So far in this course, just with this limited exposure, you understand an income statement, a statement of stockholders' equity, and a balance sheet. Two questions for you. First one. Which of the following accounts would appear on a company's income statement? Now look at the listing here. Accounts payable, cash, dividends, or rent expense. I hope you're thinking rent expense, because accounts payable is a liability that goes on the balance sheet. Cash is an asset that goes on the balance sheet as an asset. Dividends show up on your statement of stockholders' equity. So rent expense definitely on your income statement. And of course, when we're talking about accounts payable, remember, anytime you see the word payable, that implies that the account is a liability. And again, dividends, as we say here, appear on your statement of stockholders' equity. Second question for you. Which relationship is reflected in the balance sheet? And I hope immediately, within 2 seconds, you jump on the correct answer for that one. Yes, it would be letter B. Your assets equals your liabilities plus your stockholders' equity. Remember, the balance sheet is dated as of one particular date. And none of those answers will even come close to what the real answer should be. A, of course, would be yes if they were talking about a income statement in any case. But the other ones, basically, they just made up. Next of all, we have the statement of cash flows. Statement of cash flows is very important. It shows you all your cash receipts and cash payments over, again, an interval of time, not as of one day. So you have what we call operating cash flows. These are your daily operations involving revenue and expense activities that you have to incur to generate those revenues. So instead of looking at revenues and expenses, you're looking at cash received on a daily basis from your operating activities and your cash payments. When it comes to your investing cash flows, these are all transactions that involve the purchases and sale of investments and long-term assets. For example, are you buying any land or buildings or equipment or any investments, or are you selling any of those? That's not something you do on a daily basis. Operating would be, of course, the sales that you have and then the payment for the wages and all the other expenses. And finally, you have your financing activities. By financing activities, we're basically looking at the right-hand side of the balance sheet. These are all the cash transactions with your creditors or your lenders and your stockholders, whether they're investing money or you're buying back your stock in the market, and yes, companies will do that. They'll actually go out in the market and buy back their stock. But if you're taking out loans or if you're paying off loans, that goes under financing activity. So it's very descriptive. Operating, day-to-day operations, investing, what kind of assets are you buying or selling, and then with regard to financing, that involves, of course, paying off or borrowing money or actually receiving money from your shareholders as investments, and also paying out dividends. As far as a cash flow statement and what it looks like, well, we have our net income, but you'll see that income is not on a cash basis. It's on an accrual basis. And then we have reconciling items to get it to cash flows from operations. We're not going to get into this in this particular course. But just that you understand, cash flows from operations are a very important number. And of course, this is a startup company, and this is not good news. They have cash flows from operating activities as an outflow. That's why it's in parentheses. And that's not uncommon for startup companies. Now, once a company's on its feet, you want to see that they have a positive cash inflow. And you want to see that it's actually higher than your net income number in most cases. Then you have investing activities, which is not uncommon for a startup company, that you actually had $240,000 actually paid out for the purchases of assets. And those are long-term assets, not inventory or anything to do with supplies or accounts receivable. That's daily operations. And then, of course, you had your financing activities where you had issuance of stock and you borrowed some money, so you had a source there. Now, you might say, well, that's good news. Well, to me, that's not good news. For a startup company, yes, that has to be the case. You have investments by your creditors and your shareholders. But in the future, you want to see that as a negative number. The reason I say as a negative number, because that means you're paying off debt, you're paying out dividends. But again, this is a startup company here. So your net increase in cash is $458,000, and yes, that jives with what's on the balance sheet as far as your cash. So on a cash flow statement, you actually look at your change, your increase or decrease in cash. You add it or deduct it from your beginning balance, which here was zero, and your ending cash is $458,000, which, if you look back to our prior slides, corresponds with the balance sheet amount. So that is your fourth and very important, most important to me, your financial statement. The reason being is there's no estimates involved at all here when it comes to cash flows from operating activities. And let's say a year, 2 years, 3 years goes by and Eagle Robotics is still showing negative cash flows from operations. That's going to be the demise of that company. The reason being is you cannot continually borrow money and have a negative number from operating activities. Sooner or later, you have to show a positive number and start covering your investing activities and being able to pay off debt and pay out dividends. A little question for you here. Cash collected from a customer. What type of activity would that be on your statement of cash flows? And I hope right away you're looking at this particular one where it says business activity. That wasn't even something that I mentioned to you. You only have 3 activities, so it's got to be either A, C, or D. And I hope you're saying A. That would be an operating activity. Now, if they told you something like, oh, you issued a note payable and received the cash, then you would have said financing activity. If they would have said you paid cash for land, that would be an investing activity, or buildings or equipment that you bought. And likewise, if you sold any, that would be an investing activity. Operating activities, again, deal with just revenues and expense transactions. Collecting cash from your customers, paying out cash for the related expenses incurred to generate those revenues. And what about the links among your 4 financial statements? And notice again, compared to your authors, I just leave out the statement of comprehensive income. We don't need, that's, to me, I don't even look at that statement when I'm analyzing a company. It's not important to me. But the 4 basic financial statements, certainly the income statement to a lot of people is one of the most important ones, but I don't agree with that. Notice you need that number for your statement of changes in stockholders' equity, where you actually had the net income added to your retained earnings and then the dividends deducted. Then, of course, your balance sheet, they abbreviated that a lot. They show cash and all your other assets, liabilities, and stockholders' equity. But notice you needed the ending stockholders' equity number to get that on your balance sheet, and that comes from the statement of stockholders' equity. And notice, like I said before, when we were just looking at the statement of cash flows on the prior slide, that cash at the end of the period, the 458, matches the balance sheet amount, the ending cash. So that's the link between your four financial statements. And when you're looking at this overall, is Eagle doing pretty well for their first month of operations? And I'd have to say the great news is they have a net income. The bad news to me is they got a negative cash flow from operations. They're not heavily indebted at this point in time, which is good. In other words, 2/3 of the assets are actually owned by the shareholders here. But again, they have to turn this around. In the future, they need to start generating a positive cash flow from operations. Here's a good little slide that your authors show you as well in the textbook with regard to professional users out there and their perceptions of the financial statements. Notice how important the balance sheet is in the income statement and the statement of cash flows. Consistently, you see that the overall average is very high for those compared to the statement of comprehensive income or even a statement of stockholders' equity. But then when it comes to assessing the prospects of future cash flows, it seems the two most important statements of all, which show up almost everywhere and on top, would be your income statement and your statement of cash flows, as you can see here. Statement of cash flows, again, was in gray. And you see it there even when it comes to estimating firm value. When I estimate firm value, the balance sheet is okay, but for an older company, those asset numbers are out of line. They were bought a number of years ago. The assets are depreciated. That doesn't give me a clue as to what their assets are really worth. Red flags as far as too much debt, and likewise the accounting policies. Notice all three are on top. Income statement again the balance sheet in this case for evaluating risk and uncertainties. That would of course be because the liabilities are reflected on there, and the balance sheet should show all the liabilities. And likewise assessing risk. The balance sheet is very important for that. Evaluating management. Notice again all three are about the same. But a good little diagram to show you how three of the statements are extremely important to users out there. Very important you consider this. Financial accounting serves an important role. The key is it provides useful information to decision makers. That's the key. If the financial statements are not useful, then what good are they? As far as changes in stock prices versus changes in net income, there's a huge correlation between, maybe the graph is a little confusing, but look at this. The green line represents companies with large increases in net income. And notice there's tracking the investment values, that how large increases in net income are correlated with the increase in the value of the company. Whereas if a company has large decreases in net income, their value obviously is going down. So that's why we say that almost net income is really, when you think about it, the most used amount by investors out there. The market reacts on a quarterly basis to reported earnings. Now, when it comes to financial accounting standards, in order for financial accounting information to be consistent out there, you need standards. Because again, investors and creditors have to make decisions based upon this financial information. So you can't have one company on their own making up certain accounting data or reporting things a certain way that are not in conformity with other companies. So that's why we have something called Generally Accepted Accounting Principles. And the acronym for that is GAAP. It has nothing to do with the clothing store. So what you'll be learning, especially when you take your 201 courses and even in these first three chapters here, we are actually covering generally accepted accounting principles that had started as early as 1934 with the Securities Exchange Act issued by the government. Because again, you had the stock market crash and companies were not following any kind of set accounting methods and principles that we were using when reporting their financial statements. So that's why it's important that every companies are following a certain set of rules and regulations. In the United States here, we have what we call the Financial Accounting Standards Board, or FASB. That's the only rule-making body that's fair game for me to ask you about on the exam. I want you to know that this is our current rulemaking body, and yes, they have to answer to the Securities and Exchange Commission, the SEC, and that is not Southeast Conference. And with regard to the Financial Accounting Standards Board, they've been around now for some 50 years. Prior to that, we had two other rulemaking bodies as early as the 1930s. There has been a push international-wise to have some global standards where all companies are reporting consistently. And FASB does work in consultation with the two in developing new standards together. But really in the United States, our standards are not exactly the same as the global standards being the international accounting standards. Even with companies following international accounting standards, for example, with Germany versus Japan, they report things a little bit differently. So there is no set authoritative body out there that's governing exactly in detail what everybody is reporting. But a lot of the companies, especially in Europe, even Canada now and Mexico, they follow international accounting standards. But again, not to a T. They're not exact. They do have some differences with it. Objectives of financial reporting, I mentioned this earlier. It's to provide useful information to creditors and investors. And by the way, we don't mention employees, the government, management, and so on, because the investors and creditors have the most sophisticated needs. So if we can meet their needs, then we met the needs of everybody else. It's also to predict future cash flows. So not only is the cash flow statement important for that, also the income statement as well as number one. The income statement and statement of cash flows are very useful to investors and creditors. And then think about this statement. What statement would that involve? Wouldn't it be the balance sheet? tells you something about economic resources, claims of those resources, and changes in them. That justifies, of course, the balance sheet and the statement of stockholders' equity. When it comes to the demand for credible accounting information, that's why we have CPAs that are trained individuals that are licensed, and they have to keep their license active, where they're an independent from the company, and they express an opinion on that company's financial statements, and if the financial statements are in compliance with GAAP, all the generally accepted accounting principles, and are free from any material misstatement. So when it comes to your auditors, they're attesting to the fact that management has applied GAAP in preparing their financial statements. Also, a second reason why we have auditors out there is they play a major role when it comes to the credibility of the financial statements. Creditors and investors are going to feel more secure if, let's say, they get a clean audit opinion on those financial statements. Very important is the auditor's report. Whenever you're looking at a set of financial statements that are published, along with those statements will be the report of the independent auditors, where they're basically giving you their opinion. Now, all companies want to get an unqualified opinion. That means the auditors don't have anything negative to say, where they're saying that the company did have good internal controls and they complied with, of course, the company complied with generally accepted accounting principles, and the statements are, of course, stated fairly. Unqualified is where you see a little explanation about a certain item that may cause the auditors not to give an unqualified opinion. For example, let's say we have an oil company and they had a spill or an accident and they don't know exactly what the dollar amount is going to be. If that's the case, they would say everything's okay except we don't know the impact of this oil spill and how that will affect their future cash flows and so on and their ability to pay dividends. So that's where you might see an explanation along with an unqualified opinion. Qualified would be more with smaller companies where they don't have as good internal controls, where the company would say, or the auditors would say that, okay, we see that the financial statements seem to follow GAAP, but then there are some problems with internal control, which could lead to the verifiability of certain amounts or the value of the inventory. Adverse, you very seldom ever see at all, because that's just outright where the company would probably do something to at least get a qualified opinion, because that's so negative, and it says that basically the company had poor internal controls and that's it, you cannot rely upon these financial statements. Nobody's going to pay for that, and they're going to do something about it to get maybe at least move up a notch. I've never seen an adverse opinion. Even with all the fraud cases that took place out there over the decades, those companies, most of them were actually getting unqualified opinions. And you might be saying, well, how is that if these statements were audited by a trained individual and they did not catch fraud? Well, again, you've got to be careful. When auditors go in, they are not looking for detailed fraud or collusion. That's something certified fraud examiners do, and that's why your big companies do also have fraud audits these days, to make certain that they are not hauled into court and held legally responsible when they had nothing to do or any knowledge of the fraud. Sarbanes-Oxley was an act passed by Congress after many of the frauds at the turn of the century. Right before the 2000s started, there were numerous frauds taking place, and the market was losing confidence in the published financial statements, even though these companies did have audits and received unqualified opinions. So one of the features of this legislation was that it regulated the auditors and the types of services they can furnish to their clients. There's something called write-up work, where actually the auditors would be preparing the books and the financial statements themselves, then turning around and then offering an opinion on those financial statements. That prevented them from actually doing that anymore, because obviously they were auditing their own records. Also, it increased the accountability of the corporate executives. It basically said that corporate executives were responsible for having a good internal control system. That means where you have the segregation of duties, you make certain that there's a line of command, all the other good things that go with internal control, which you'll study in your 201 course. And then it provided some very stiff penalties for the violators, especially if the CFO or CEO was actually complicit in the fraud. And that's why so many companies nowadays have actually fraud examinations as well as their regular audits, where the auditors offer an opinion on the financial statements. They hire what we call certified fraud examiners to go in and actually look for fraud and collusion among employees. Also, it's stiffened up what the auditors do, because their work papers are now reviewed by other auditors. So you have auditors auditing auditors. And then also the auditors no longer report to top management. They have to report directly to the audit committee of the board of directors, because in all the fraud cases, especially with Arthur Andersen and that big large firm went out of business, the partners on that job were actually complicit with the fraud with the top management of Enron. So there are many more requirements under Sarbanes-Oxley, but that just gives you a flavor for some of the legal requirements that are now companies have to face in this day and age. And also they have to have a really good internal control system, and the auditors actually offer an opinion on the internal controls of that particular company. The annual report can be very, very long. That's why you won't see one at the end of your ebook. Oftentimes they can be anywhere from, let's say, 40 to actually 60, 70 pages in length. So in that annual report, the company starts out, of course, and discusses all kinds of management issues, their plans for expansion, and then you have the annual report part of the financial statements. And that can be a good 25, even 30 pages long, where you have your typical financial statements, the balance sheet, income statement, statement of cash flows, and so on. And then you have additional disclosures with all the notes to the financial statements. So there's a lot in an annual report. And you can go to any company's website and see what their annual report is. And also they have to file something with the SEC called the Form 10-K. And that, again, is often something like 50 to, I've seen some almost 100 pages in length with that annual report. Disclosure notes are always part of that annual report. They're part of the financial statements. There's all kinds of disclosure about the accounting policies, which you will not study in this course, but in 201. Subsequent events they talk about, related party transactions, management discussion analysis with a lot of graphs and predictions and forecasts about future earnings and expansions. And then there's even disclosures in the 10-K report about executive compensation. So that is all for the benefit of shareholders and potential investors. And the disclosure notes, again, can be anywhere from, let's say, a short annual report, maybe 10 pages, but up to 50 pages in length. Also, part of those notes, you have your summary of significant accounting policies, which I mentioned before. You'll be studying in your 201 course, and why management decides to pick FIFO inventory versus LIFO, what kind of depreciation methods they're using. There are various types. Also, their policies regarding the timing of recognizing revenue and estimating bad debts. There's all kinds of estimates involved in accounting, and that's where you'll see a discussion of those under the significant accounting policies. Management's discussion analysis, as I mentioned earlier, covers a lot of different things in their annual report. Just operations, what took place this year, their liquidity, capital resources, off-balance sheet arrangements, where what are they leasing, and critical accounting estimates. So you have a lot of other details besides your just, when we say the annual report versus just the financial statements themselves. Typically the financial statements themselves, excluding the notes, only take up a few pages of an annual report. Compensation of directors and top management, the SEC does require that in the Form 10-K. Also a proxy statement including compensation information for the directors, and as I said before, your top executives. Also, you have an invitation to stockholders to the annual meeting to elect the board and to vote on new issues. So there's a lot of disclosures, to say the least. Quarterly reports, you see those being published by your top companies, and again, they have to file a 10-K quarterly report. You'll see the full set of financial statements, again, management discussion analysis, and the notes are not as elaborate as their annual report is, but still, these can be a good 20 to 30 pages in long, a quarterly report, which of course the market always looks at. The market is not blindsided at the end of the year where all of this information comes out only once a year. Companies have to report quarterly. Sustainability disclosures are now a big thing, where this is all on a voluntary basis. Companies release detailed disclosures about environmental issues, social disclosures that are of interest, and again, their impact on society overall and how they treat their employees and likewise customers. And of course, environmental issues, as it says, their impact and how they're trying to be more conscious as far as energy usage and polluting. And then your governance disclosures, that involves things like the division of power within the company. So again, this is all voluntary, but it's becoming more widespread, and eventually a lot of people believe that it's going to be acted upon and required by the SEC eventually. When we're talking about environmental issues, I didn't want to mention too much in detail, but here are some good examples. Their emissions, their air quality, energy and fuel management, water and waste, hazardous materials, especially when you get into your manufacturing companies. Those are very important to the stakeholders, being the creditors, the shareholders, the employees, and so on. And remember again that employees and management have a very direct interest in the annual report and all of this discussion. When it comes to the social and human capital, labor relations, favorable labor practices, if they had any violations, diversity and inclusion is part of that, health and safety of our employees, compensation and benefits plan, recruitment and retention, all of these, human rights. So there's a lot that falls under the social issues. And some people now, and even investment funds, are actually looking at all of these disclosures and taking that into account when they allocate their monies to various investments. And finally, you have your governance issues. As far as are your board members independent, as far as business ethics and conflicts of interest, their competitive behavior, political influence, how much are they donating to campaigns, and any illegal practices if they have some suits against them by the government or DOJ. So again, these last three that I talk about are just, not that I'm going to test you on these or to know the different types under these, but just to give you an awareness now that that's the trend that eventually auditors may someday have to audit, but right now it's all voluntary information. And that should be it for this very first chapter. The next one will get into a little bit more details on the financial statements themselves.
Canvas. So what you have to do is make certain you're reading the chapter first, and then listen to the chapter lecture.